Hey guys, it's Kieran. In this session, I'm going to go over two trading styles, scalping and swing trading, and really try to bust some myths regarding which one is better. The question is, are you able to do better scalping or swing trading, and which one actually brings more profit? So just typing certain stuff out. So let's look at scalping. There's so many misconceptions about scalping. What exactly is scalping? So there's different definitions. Some people classify scalping and day trading as pretty much synonymous with each other. Generally speaking, for scalping and day trading, I really would expect at least 2 or 3 positions at the least in a day. Very often closed overnight. So very often scalpers do not like to let positions run overnight, but of course you can convert from a scalp to a swing trade as well. Some people use definitions for day trading like at least 4 trades in 5 days. But I think the general consensus is that it is a high frequency trading style. So amongst everyone here, I think a lot of people are scalpers. But the question I want to ask you is this. Which trading style do you think leads to a higher amount of profit? A scalper or a swing trader? And let me bust some myths, okay? So this is general, very concise definition of scalper. It's to do with the frequency of trading. Scalpers generally tend to trade a lot more. Very often do not leave positions overnight. But I'm curious, let's go over how the equity curve of a scalper might really vary. So if I draw a curve here like this, so pretend this is the account of a scalper. Pretend this area here is the target. Generally speaking, a scalper's equity curve looks like this. So this is the line here. And if you can notice here, it's like this. This is the account. So of course, accounts are swings. But if you notice, the ups and downs are less extreme. They're more or less a tight range, where the gains and the wins are pretty much modest. And if you can notice here, how it pretty much centers around this mean line. And at the end of the month, or wherever the target, the profit target has been met here too. Generally speaking, people have this notion, what is consistency in trading? Does consistency in trading mean that someone is making $500 every day? Well, no, because if you want to be consistent in trading, and if you're aiming to make $500 every day as a scalper, that essentially means you need to factor in certain other things. In an average week, you're probably going to have 2 good days, maybe 2 losing days, and 1 break-even day. And so that means that if you're aiming to make $500 a day, that essentially means that you're hoping to make $2,500 in a week. Because usually there's only 5 trading days. Of course, it depends on the instrument. So in a sense, in that 2 winning days, you need to make 5 times 5, which is 2,500 divided by 2. And so you have to make $1,250 each of those 2 good days. Because you have to bear in mind that there's going to be losing days and there's going to be break-even days. And ultimately certain winners are going to break even or even balance with the bad days. And so if you want to make $500 a day for a week, so in a sense $2,500 overall, $500 a day is not enough because you're not being realistic because you're going to have losing days as well. And so this is why you cannot let your winners, really good trades, the problem is if you're going to cut the winners short, then you're ultimately going to really affect the bad days really badly. So this is a scalper's general equity curve. Mostly it's a tight range, few modest wins and modest losses, but in some sense this is some people what classically associate with consistency is. But consistency is not so much making the same amount every day. Consistency is more about having an edge that consistently delivers time and time and over again. Every edge has ups and downs. You have to always consider. So let's look at the swing trading. Swing trader holding at least 2 days. And in some cases up to 2 weeks. There's different definitions, but this is generally conventionally seen as a swing trader. You're generally holding positions a lot longer. And very often, once you go beyond 2 weeks, it does get a bit more in that investing category. But of course there's overlap. Then there is a third category, of course, that I want to also touch on here as well. And this is intraday trader. This is somewhat in between these 2 categories of trading. And there is some overlap between an intraday trader and swing trader and scalper, because an intraday trader might not. So scalper might use, for example, the 1 minute or the 5 minute chart. In some cases, some people use a 15-second chart. But an intraday trader might use the 15-minute or 1 hour chart, and sometimes the positions can go into swing trade. And so there's of course this overlap. Before I tell you which trading style is better, I want to just draw the equity curve, what I expect of usually a swing trader. And it can be a bit different to what you think. As per the name sounds, usually you have this median line, And a swing trader really incurs huge swings like this, as per the name. It does reach the target here, T. It requires a lot of discipline as well. For example, some people cannot really cope with being in such a huge period of drawdown. And imagine entering a trade and losing that trade, and having to wait sometimes 2 weeks for the next trade, and then winning the next trade. Often also the risk-reward ratio is a lot higher in swing trading. It might be a 1-3, 1-4, potentially 1-8 in some cases. Scalping, generally speaking, usually looking for a 1-2 or 1-3 risk-reward ratio trade. And so to answer that question, which trading style is better? What leads to more profit? Okay? I know a lot of people have typed in the chat, it's swing trading, and I myself thought this too as well. But what the evidence actually suggests is that, drum roll please, it doesn't matter. You can actually make the same amount of profit at the end of the month, whether it's 10% account growth or 8% account growth in either trading style. The only difference is that the journey is different. In here, for example, you're taking more trades, and your trading equity curve is a bit smoother in that sense. But here, your trading equity curve has a bit more peaks and troughs, and it's a bit more ups and downs, but you're still reaching the same target. So there's different routes to the same end destination is what I'm trying to say. And the evidence suggests that it doesn't matter what your trading style is. The most important thing is actually the strategy. The strategy is more important than actually the trading style. You can be successful in both. And the reality is that it's not so black and white. I myself, I would say I'm in between this. I'd say currently right now, initially I was just a swing trader, but now I'm more 50% swing trader and 50% scalper. And the beauty is that my equity curve is a hybrid of these two. My equity curve is more like this. Like this in some sense. So I have that swings of the swing trading, but at the same time, it's a bit smoother because I'm just scalping as well. So it's more like this, to be honest. Equity curve. And can someone explain why you might have dips like this? Can someone explain why? Well, yeah, you might have guessed it correctly, yes. It's because nothing goes up in a straight line. There's going to be certain months where perhaps the market condition change. Perhaps the market condition has trending instead of range bound. My strategy is actually a higher win rate in a range bound market condition. And so you have to appreciate that any strategy will have certain dips and ups and downs. But the main thing is over the year, you have a general upward trajectory. One of the biggest things to always look out for is the equity curve. Is your equity curve going up over time? And the beauty is that the numbers do not lie. If you think a strategy is working, but the equity curve is not going up, there's a huge problem, okay? But I'm going to go with some chart examples as well. What I'm trying to illustrate is that both scalping and swing trading work hand in hand. You probably will do both. It's very rare, even if someone's a day trader, they probably might, for example, even in my situation, I might keep one account for scalping, another account for swing trading. And so the skills work hand in hand. That's the beauty of it. For example, if you're a scalper, and imagine you have that once in a year opportunity to pretty much create generational wealth, but you enter a scalp trade and you close it too early, you could have essentially let that position run and have made, in some occasions, made more from that single trade than you would have made from the rest of the year. Very often, once a month or once in 2 years, this kind of opportunity comes. And so, if you're a scalper, but you had that swing trading skill set, you might have decided to yourself, look, I'm going to enter this trade as a scalping mentality, but I might leave 25% of it to run, okay? And similarly, if you're a swing trader, the scalping mindset and skill set can really help as well. Because as a swing trader, if you're aiming for a 1-3 risk-reward ratio trade, if you're able to fine-tune your entry and really get into that scalping position, then you might, instead of making a 1-3 risk-reward ratio trade, you might even get a 1-6 risk-reward ratio trade. And so the beauty is that it works hand in hand. And I'm going to give an example of this in the chart as well, specifically in swing trading. So I've marked out a potential swing trading strategy. It's pretty much using smart money concepts. This is one of my 5 strategies, and essentially looking at demand and supply. It's a traditional concept really in trading. For example, you have order blocks. For example, sometimes what happens is that when the market dumps, let's look at the daily chart like this. It dumps like this, then you have a bounce. Very often, if there's another bounce or a dump here again, you might have another reaction because this red candle before this run up actually served as a bounce region. For example, here as well, you can see how initially this was a red region. We pushed above, bounced at this red candle before the run up. And this is essentially simply put a demand zone. Of course, there's more to it, right? But then we pushed up here again. We had a recent dump here again. And again, we bounced off this demand zone, this red candle, the zone here. This is an order block or a demand zone. And the opposite, the supply zone, essentially you're going to have retracements. So the green candle before the push back down. And once you go back up to this, run this green candle before this run down here, you initially had another reaction at a dump here, and when you go up back again to the green candle before the push down here on the daily chart, you another have a reaction down like this. So looking at this, for example, I've marked this out. So supply zones, some people use the word resistance, and the demand zone, some people use the word as for order blocks as well, or support. And of course, it's a zone. It's not just a straight line. But you can also use the MDX algo indicator as well, and this is essentially maps it out for you, which is very nice. And so these are some supply zones, and this is the beauty of the indicator. So if you notice, you go like this, it also tells you in short and sell as well, short and long, and also it maps out the 4 hour. This is one of my favorite features as well, actually, of the MDX algo. It actually maps out it's just loading, but it also maps out the 4 hour demand zone as well. And you can see currently the Bitcoin price action, this 23.9, 24K region to 24.5K region is a demand zone. And these are just mapping out some order blocks. So essentially, before I go over a practical example, these red zones are the supply zones and the green zones are the demand zones. So practically, how can you enter as a swing trader? So say, for example, you mark out a key demand zone, particularly on the daily chart here, and you notice certain reactions here, of course, in the 4 hour as well. For example, you go to the 4 hour chart here, you have a bounce, 4 hour here and bounce. So if you decide to enter a swing trade here, you would just enter along and really go as a swing trader. You would go into swing trading. As a swing trader, you go into the scalping mindset and really fine tune your entry. And you would just enter the long, tight stop loss below the lows here. And you would just aim to target the next order block. So this next supply zone. And this is an example of how, as a swing trader, you could have used a scalping mindset to really fine tune your entry, but then just ride the trade to the next order block and this next supply zone. And similarly, if you enter this position as a scalp, but then eventually you got above this and back tested this, you could have maybe closed off 75% and let the last 25% of the trade to run. And this is an example of how, as a scalper, you can have that mindset of taking that 75% off and letting that 25% run. There's that expression that no one ever went broke taking profits too early, right? I'm sure everyone's heard that. But at the same time, no one ever got rich by taking profits too early as well. So it's a fine balance between that. What you'll find is that the person who enters a trade, as a scalper particularly, but then often leads the last 25% of the trade to run when they see a good opportunity. And if they keep doing that, their win rate might be low, but over the actual long run, the actual statistics show that they're more likely to be a profitable trader. Because whilst they might get stopped out more, that last 25% left to run in really high probability setups can actually be the difference between upgrading to the next account size. And so this is just pretty much a short video of how you can really balance that swing trading and scalping mindset, and both work hand in hand. One is not really better than the other. And the reality is that people use a combination of both, in real life. You don't have to just stick to one particular trading style. And in summary, what I'm trying to say here is that the trading actual time frame and the trading actual technique that you use, whether it's swing trading or scalping, it doesn't make a huge difference. You can still make the same amount of profit at the end of the month. It's just the route and journey is different. What's actually more important is actually your trading strategy. And the ultimate way to assess if the trading strategy is working is the equity curve. Does it have a smooth upward movement like this or like this? Of course, there's bigger swings here, and you're going to have natural dips. But if the actual count equity is going down, you yourself will know by just judgment, then it could be the biggest warning sign that the strategy just is not working. Yeah, but this is all I have to talk about really in this really important topic.